Hello and welcome. Today we are going to do something a little different. We're going to act like financial doctors and give a complete health checkup to a really vital part of India's economy, the non-banking financial company sector, or as you know them, NBFCs. Now, if you're prepping for exams, you know this is a hot topic, so let's break it all down together.
So, here's our game plan. First, we'll figure out what exactly these NBFCs are. Then, we'll look at the new rulebook from the RBI. After that, it's time for the actual health check. We'll dive into the numbers. We'll also solve a little puzzle about monetary policy. And finally, I'll give you all the key takeaways you'll need to ace your exams.
All right, first things first. We need to identify our patient. What in the world are non-banking financial companies? And why does everyone say they're so incredibly important for the Indian economy? Let's find out. Okay, so here's the textbook definition, straight from the RBI Act. But what does that actually mean in plain English? Think of NBFCs as financial institutions that do a lot of what banks do. Give out loans, make investments, but they don't have a full banking license. They're often more specialized, more agile, and they serve niches in the market that big banks sometimes miss.
But here's why they really matter. They are literally the arteries of our economy, pumping credit, which is like financial blood, into every corner. From the massive new highway being built, to the car you drive, to the smartphone in your hand, there's a good chance an NBFC helped finance it. They are what fuels demand and drives growth.
So, every important patient needs a good doctor giving out orders, right? Well, in India's financial system, that doctor is the Reserve Bank of India. Let's take a look at the brand new set of rules, the doctor's orders, if you will, that the RBI has prescribed to keep this sector healthy. And here's the big new jargon you absolutely have to know. SBR, or Scale-Based Regulation. This is a complete game changer. You see, before this, the RBI kind of had a one-size-fits-all approach. SBR is much, much smarter. It basically creates 4 layers, and the rules get tougher as an NBFC gets bigger and more important. So the bigger your footprint, the closer the RBI watches you. It's a tailored, risk-based approach.
All right, it's time. Let's get out the stethoscope and read the vitals. We're about to do a deep dive into the sector's financial reports to see just how healthy it really is. This is where we look at the actual data.
So, first question, where do NBFCs get their money? This chart tells a really important story. Look at the 2 biggest slices. They get a huge chunk of their funds by borrowing from banks and by issuing debentures, which are basically bonds sold on the open market. Together, that's nearly 3/4 of their funding. This tells you their health is deeply connected to the health of the banking system and the mood of the financial markets. And now, where does all that money go? Well, this table breaks it down. Industry gets the biggest piece of the pie, but look at how close retail loans are right behind it. This is so interesting because it shows the dual role NBFCs play. They're funding big factories and businesses, but they're also funding personal loans for people like you and me.
Now, to really check a lender's health, you have to look at their bad loans. The official term, and another one for your exam notes, is gross non-performing assets, or GNPAs. All this means is a loan where the borrower hasn't paid anything for 90 days. A lower GNPA number is a very, very good sign.
So, what's the verdict? The latest reading for the sector's GNPA ratio is 3.4%. That's a pretty healthy number on its own. But a single data point doesn't really tell the whole story, does it? The trend is where things get really interesting.
And just look at this trend. The bad loan ratio has been falling and falling consistently for the past several years. This chart is a fantastic sign. It shows that the sector isn't just healthy now, its health and its ability to manage risk have been steadily improving over time. That's a huge vote of confidence.
Okay, next vital sign. We've checked the quality of their loans. Now let's check their strength. The key metric here is CRAR, the capital to risk-weighted assets ratio. Think of this as a financial shock absorber. It's the cushion of capital an NBFC has to soak up any unexpected losses. The RBI says this has to be at least 15%.
And the results are? Well, they're fantastic. The sector isn't just scraping by at 15%. Not even close. They are maintaining really strong capital buffers, way above what the regulator demands. This means they have a very solid defense against any economic turbulence that might come their way. The patient is strong.
Okay, so we've established our patient is in good shape. But how does it interact with everything else? Now we get to solve a really interesting puzzle. The connection between NBFCs and the RBI's monetary policy. How do those big interest rate decisions from the RBI actually ripple out and affect them?
This is such a crucial concept to grasp.
See, banks have a direct hotline to the RBI. When the RBI changes its key policy rate, the repo rate, banks feel that change in their funding costs almost instantly. But for NBFCs, it's different. It's an indirect transmission. Remember? They borrow from banks and markets. So the RBI's signal has to travel through those channels first, which naturally creates a bit of a delay.
And that, of course, leads to the million-dollar question, a question that's super relevant for policymakers and, yes, for your exams. Just how much of an RBI rate hike or cut actually makes it through to the NBFCs? Is the signal loud and clear, or is it just a faint whisper?
Well, we have data on that, and the answer is fascinating. The pass-through is partial and it's slow. Check this out. A full 1% hike in the RBI's repo rate only leads to a 0.24% increase in the borrowing costs for NBFCs. And get this, it takes about 9 months, or 3 quarters, for even that partial effect to fully kick in.
So, what's the bottom line here? This is a critical finding. Monetary policy transmission to the NBFC sector is positive. Yes, they do feel it, but it is fundamentally incomplete. The signal gets through, but it arrives a bit late and it's a bit muffled.
And with that, our diagnosis is complete. It's time to write out the final prescription. Let's pull everything we've learned together into a clear, simple summary of the most important points you need to remember.
So here it is, your final prescription. Number 1, NBFCs are more important than ever for India's growth. 2, they are now regulated by the smarter, risk-based SBR framework. 3, their financial health is robust, with good profits and falling bad loans. 4, they are very well capitalized, with strong shock absorbers. 5, remember their funding mix. They rely on banks and markets. And finally, number 6, because of that funding mix, monetary policy affects them, but only partially and with a significant lag.
And I'll leave you with a final thought to chew on. As India's economy continues its rapid expansion, is it possible that these more agile, more specialized NBFCs could actually become the main engine of credit? Could they one day outpace the traditional banking system? That's a huge question, and the answer will shape the future of finance in India. Thanks for joining me for this deep dive.